it does work now.
There you go. Yeah, says that up on the screen.
You just got to keep trying.
Exactly. The philosophy of life, right?
All right, so let me see. There you go. Here's the link. Just in case if you want to. Oh, I better. You just got to keep trying. All right, I muted myself, but I'm gonna send you this link in case you want to try.
Yeah,
and
cool. Thanks.
There you go. All right, it's 4 o'clock. Perfect timing. I'm gonna go ahead and start the webinar, but you can still hear me okay?
Yep, you're good.
All right. Hey, Marvin. Marvin is here to join us to monitor behind the scene, just to make sure everything runs smoothly.
Okay.
Or just kind of nudge me a little bit saying like, hey, you have something in your teeth or something.
Hey, Greg, how's it going?
I'm good, Marvin. How are you?
Doing well.
All right. Okay, sorry. There. Can you see my screen?
Yes.
Perfect. All right, I'm gonna go ahead and start. And I just want to welcome everybody. This is the on YouTube. Want to welcome everybody. If you're watching, this is my first time streaming on YouTube. Learned this from my friend in Sacramento who was streaming live last time. I thought it was a great idea, so I thought I'm going to try it this time. But I want to welcome everybody to our today housing market town hall webinar. We have so much data to share as usual. It's just data, data, data. I love statistics. I love graphs and charts. And so does Greg, our special guest today, Greg Paquin.
You got it.
I had to ask. I was like, please make sure I got your name right. So I thought this would be a great segment to talk about the current and future the future trends of the new homes, because we're starting to see it and hear a lot of people getting their new homes contract canceled. And the new home builders obviously have different strategies nowadays. But I'm excited to have this whole conversation, but let's start with what we usually start with is to give you some introduction of our today's speaker. He is the founder and the president of the Gregory Group, a real estate information and consulting firm. And as an expert in residential real estate and land development, Greg has been through 4 real estate boom bust cycles and is considered a leading voice on future trends, home design, real estate economics, and demographics, and buyer segmentation. Now, I kind of smile about this is because I think because we haven't been in a recession for so long, and for some of us, we've been in the industry for a long time now. We kept saying like, oh, this is nothing compared to the last recession or compared to the ones in the 80s. So, so I'm really interested to hear what you're going to say later on about this particular recession.
Well, we're not in a recession yet.
Not yet. Exactly. Yeah. And that's actually, that will be another discussion too, whether we are in a recession or not already, and whether our housing market is going to crash or not because of this so called recession. So yeah, we're going to have a lot to share. But first of all, if you're on this channel right now, you probably have subscribed to our channel already. If you're not, please do subscribe, because we constantly providing you with a lot of data every single month with the most up-to-date information about the market. We are very local, specifically about the Bay Area housing market, but we also want to share with you some of these real estate education. For example, last month we had talked about the pros and cons of Delaware Statutory Trust as an alternative 1031 exchange vehicle. And we had many different topics, so feel free to go onto our YouTube channel and check those out. And of course, if you are on social media, feel free to follow us on Facebook, LinkedIn, and Instagram. All right, last month, we talked about 6 factors that can lead to a recession. There are 2 things that I kind of want to go over again with you guys. That was, we talked about GDP and also rising in unemployment. Now, those are the two of the factors that typically we would consider them part of the recession, aside from the bankruptcy, defaults, or foreclosures, high interest rates, falling asset prices, and lower consumer spending and consumer confidence. We're going to touch on a little bit on the consumer confidence as well today, but I really want to focus on these two, number 1 and number 5, about the unemployment and GDP. The reason why is that I just recently watched a video on YouTube. It's by Wall Street Journal, and this is by John Hilsenrath, and he's a Wall Street Journal senior writer. He said that this 2022 recession would be unlike any other. So I was like, okay, I'm curious. I want to watch. I want to see what he means by that. And the first thought was that he's going to say this recession is going to be really bad, and it's going to be worse than the previous ones. And then once I started watching it, I thought it was very interesting. And that was kind of like what I've been talking about in our last episodes. Why this recession is a little different. And then there are a lot of factors that we cannot really right away saying that, yes, this is going to be really bad or it's going to be okay. So one thing is that we mentioned is the GDP, right? Obviously, when recession starts, the way we consider there's a recession is that we see there are 2 consecutive quarters of slowing down on the GDP, which we do have right now. So we are kind of consider that this is the beginning of the recession as one of the factors. Now, the other one is that if the GDP comes down, then it can affect a lot of businesses. And one of the 3 things that this video have talked about was that the businesses can lay off workers, right? And then people spend less money. And if people spend less money, then these companies will make less profits. And so this is like a cycle. And then of course, again, the business will lay off workers again. So, okay, with these factors, now we also do know that without businesses laying off workers, we've been talking about the unemployment rate being really strong these days. And as a matter of fact, we have this labor force participation rate that they show. Instead of people not able to find work, it's the other way around. The people are not really participating in the job market. And there are way more record high unfilled job rate instead since 2020. It just shot right up during this pandemic. So as a matter of fact, we see everywhere that there is like hiring signs that companies are really trying to hire right now. And so in typical recession, for example, around 2001, as you see, the red line is the unemployment rate that's going up, right? It should be. And then as the GDP comes down, that should be the normal recessions or in the past recessions. However, in today's world, we are seeing more of the GDP is coming down, but the unemployment rate is also coming down. So I think that's one thing really interesting, and we had talked about it in the past episodes, is that the employment rate is still going strong. We are not seeing that it's going up yet. And then on top of that, we look at the consumer confidence index. Now we have super, super high consumer confidence index in 2020, went up to 41.4. We went from negative 33.4 bounced up to 41.4 as soon as the market kind of opened up. But now we see that it has come down, and it came down to 1 in June of 2022. But if we look at the chart at the bottom right here, we are seeing that where we are right now is slightly below the 0 line. And then if we look back 25 years, we are not, I guess we are still low, but then we are not significantly lower than before, and especially during the last 2 recessions. So this could still continue to come down, don't get me wrong, but it's just that at this moment, the consumer confidence level doesn't seem to be that low yet, although we do see a lot of pessimism in the market and in it really depends. I feel like it really depends on how the internet's been sharing the information as well. But we definitely see that the consumer confidence is getting lower. Now, then in that case, does it mean that this is actually making fewer profits? On the contrary, we actually see corporate have been having really high profit margin and is a record high profit margin. And they also have tons of cash, almost $4 trillion cash, corporate cash on hand. So the businesses, according to this YouTube video with the Wall Street Journal, they're saying that because the corporations, they have so much cash on hand and they've been making quite a bit of profit, it's potentially could be that they have enough money and then they're not going to be laying off the workers because they still have enough money on hand. And so if people have jobs still, they still have employment, then it may not actually really affect the economy, or, you know, like for example, in our industry, real estate industry, is going to be affecting that much. But again, I'm not here to tell everybody that, oh, don't worry about it, our housing market is not going to crash. I just want to share with you these data that I found online, and then also putting, let you think about it. Think about whether this market is really going to crash or not. And definitely would love to hear what you think as well. All right, but now for the fact that we also, this is another article I read on Silicon Valley Business Journal. There are 3 big multifamily property sales in the Silicon Valley market, because this is one thing that, as many of you know, that I'm also specialized in multifamily. And we always wonder, well, if the interest rate has gone up, that means the cap rate will go up. If the cap rate go up, will there be a lot of sales going on? Will people be willing to sell, or will people still be willing to buy because the rate continue to go up? And funny thing is that just last week, I should say like end of July, there are 3 investment firms, different investment firms collectively spent nearly $575 million to buy 3 different apartment complexes in the South Bay. Now, the purchases are an indication that investors are bullish on the future of Silicon Valley's economy. And that's one thing I thought about, is that we have discussed before that there are a lot of companies, for example, Google, they're building this massive, massive complex. So in order for them to fill these complexes, they will have to continue to hire in the future. Obviously not right now, but in the future. So they got to have some confidence in this market. And then it looks like these investment firms, they also have some confidence in this market. And they see that this optimism is that many of the region's big tech companies expanded their office space during the pandemic. And that's the indication that they expect to continue to grow and hire. And also many are requiring employees to be in the office at least a few times a week. And such mandates are going to ensure those workers will remain in the area, and many will likely want to live near their offices. We definitely have started to see quite a bit of, or a number of offices or number of companies are requiring their employees to come back to work at least part-time, 2-3 times a week. So it will make it almost, at least to me, impossible to be living out of state and then come back 2-3 times a week just to work in the area. So we're definitely probably going to start seeing some people either moving over or coming back to the area in the future. All right. Now, with those information, I kind of want to share with you now with the Bay Area housing market stats and see how it compares, and then how it's, maybe you are looking for a home right now, maybe you're trying to sell, or maybe you're an agent trying to help your clients right now. And so let's take a look at the housing market stats. First of all, we're going to look at the offer battleground. I call it a battleground because used to be really a battleground. You have to compete with 20, 30 offers, right? But now, again, we now start seeing a lot of single digits. And surprisingly, there are still multiple offers, unlike what the news might have said, that the market is very, very cold. There isn't a lot of buyers on the market, definitely have less, but as you see that, we still see multiple offers. Now, we do also notice is that some of these, because right now, especially in the summer, typically it has already been slow every summer because families go on vacation. But right now, because of the inflation, because of the interest rate hikes, there are even less people coming out to look. However, they're taking a pause doesn't mean that they're not looking. So if the price is attractive enough, it will get them to come out and look at the properties. And this is what happens is that we start seeing a lot of people put their very low offer price or asking price and attracted a lot of people to come in and then still have numerous multiple offers. The only difference is that now the multiple offers, people are a lot more conservative when they are making their offers. They're not going above and beyond the asking price. Now, as an example, San Leandro asking price is $599. They sold it at $765. It's still a pretty significant amount, I think, for this particular situation. In Fremont, 1.5 asking and sold it for 1.6 with 3 offers. Now, but then if we look at, let's say, Santa Clara, the original asking price was 1.998, and it actually dropped to 1.95. And then now they received 3 offers and still sold it slightly below. That's what we are seeing now, is that a lot of sellers are dropping their price, or I should say a lot of buyers waiting for the sellers to drop their price before they make an offer. So this is another example. Cupertino, their original offer price was 3.886. They dropped it to 3.595. They got 3 offers in, and then they sold it at 3.752. Et cetera. So you can see the trend over here. It's not crazy over asking price like before, but we are still seeing quite a bit of competition, and we're definitely seeing even more cash offers, because right now, a lot of people, if they have cash, they definitely want to come out and use that as a leverage to negotiate. All right. And on top of that, we've been tracking the months of inventory. We've been saying that a normal market, more of an equilibrium market, is around 4 to 6 months of inventory. And we used to be less than 1 month. And that's why you saw that everything comes on the market within the week, we sell it. And it started to climb up since May, June to 1.9, and then July went to 2.1. And it shot up all of a sudden in August to 3.8, close to 4 months now. And in terms of days on the market, we have gone from just a week up to almost 3 weeks. So I would say 2.5 weeks around there. And then you see that people are definitely not as aggressive as before. They're only offering right around the asking price. And we start seeing a lot of people offering maybe slightly below asking price. And then if there are some multiple offers or they price it really low just to attract people, people are still not aggressively offering way above asking price. And in terms of number of listings withdrawn or canceled, we've been seeing in Santa Clara County, San Mateo County, Alameda County, and Contra Costa County, they all have been going up until June. And then July, actually, they all start coming down slightly, coming down a little bit on the withdrawn and canceled. One of the main reasons I could see is that because sellers at the time when they're getting their property ready around this time, when they put it on the market, that's when it started to drop. And at that point, they still wanted to be, to be able to sell it at like the March valuation, but they realized they can't. So they was like, okay, we're going to take it off market and wait until the summer is over. By the time they are putting on the market in the summer, or July, now some of the sellers, they really, really need to sell. They're not going to take it off market. So this is also another reason why we're continuing to encourage buyers. In the summer, right now, August, you still have some time. If you do see a property, please do try negotiate with the sellers, because if the sellers are on the market right now, typically they are really motivated and they really want to sell. And let's see, where is my next slide? There you go. List price decreased. How many listing price have been decreased? I was a little bit shocked. I know it's going to go up, continue to go up, but as you see, Santa Clara County, Alameda County, well, actually really San Mateo County as well, and Contra Costa County in the month of July just jumped up significantly. I'm talking about almost 3 folds in July for Santa Clara County. That's how many listings they have to drop their prices. So I've heard so many people, some of the sellers and sometimes my friends of some sellers will tell me that they feel very discouraged. But I just want to again emphasize that this is the market, unfortunately, that we are in. It is really not your property per se, but a lot of sellers are on the same boat and they all have to drop their prices during this time. And it's almost like a strategy now, because we mentioned earlier, a lot of buyers, they wait for the list price to drop before they even make a move. So work with your realtors, make sure that you are pricing your property the right way so that you can attract an offer. But don't worry, the sellers of the top 10 states that have most dropping prices is not here yet. But we see that in Boise, Idaho, 61% of the sellers are dropping asking prices. Denver, Colorado, Salt Lake City, Tacoma, Grand Rapids, Sacramento. And these, did you notice these are all the areas that used to be the hottest market in the country, everybody wants to move to. And now they're also dropping prices as well. So it is definitely happening all over the country. And in terms of transactions fell through, I feel like the numbers, even though it is increasing, is not as much as I thought, because one of the things is that some people think, well, if the market is changing, some buyers may have gone under contract and then they regret it. It's like, oh my God, the market is dropping, so I better pull out. I would much rather to lose my earnest money deposit than going in. Although we are definitely seeing more, but considering 4 counties combined, we're only seeing less than 200 deals that have transactions fell through. Is not as bad as I thought it would have been, because some, considering like how much internet news about how bad this housing market is gonna go. Now, in terms of the median sales price, it is definitely coming down for these single family homes prices. In Santa Clara County, we had gone down to $1.65 million from the highest at 1.95. And then San Mateo County, it went from the highest at 2.25 in April, came down to $1.8 million. And Alameda County went from 1.5 in May, now came down to 1.225. And Contra Costa went from the highest at 980, now came down to 860,000. They kind of came down about 20% from the peak in 2020. But if we are looking in terms of like from last month, we came down about 4% for Santa Clara County, but actually still positive from last year of August. And then San Mateo County, it didn't change from July, but from last year, it came down to 2.7%. Alameda County came down 4.67% from last year, and Contra Costa County came down 1% from last year. So the biggest question is the housing market going to crash or not over here, right? And there's this big debate between Dave, well, I guess they're not really debating. It was just Patrick Bet-David believed that Dave Ramsey, who's very vocal about that, he doesn't think there's going to be a housing market crash. One party think that there's going to be a surge of inventory coming onto the market because all those sellers who did not want to sell yet, thinking that the market is going to continue to go up, and then now they're going to start coming back out to sell their property. And Dave Ramsey is saying that, look, our current supply is just not high enough. Compared to 2007, we have 3.7 million properties on the market. Right now, we are only 1/4 of what we used to have. So there's no way we can even catch up to 2007 level. So there are these two debates. So that's why I'm kind of curious. I just wanted to look at the supply in our counties versus our demand. If we look at the supply, definitely have gone up. If we just look at the past 12 months, is at 9,774 listings. This is active listings. And if we're looking at the differences between the supply and sold, this is about, we see that mostly there are about 2,000 something listings differences. And including this one is probably one of the largest differentiation, would be about 2,000 or 2,000 something listings differences. Now we have this one in 2021. We actually have way more sales, a little bit more sales than the active listings coming on the market. But if we look at July, this differentiation, we have about 5,727 is probably one of the largest. What I'm trying to show here is that we do have higher supply in the last compared to the last 12 months. And we do have a quite low of a demand compared to the last 12 months. But if we go back 3 years and look at 3 years number, then we see that our supply here is actually not the highest. We are kind of still lower than 2020 level and also definitely lower than 2019 level. The demand in terms of like how much sales we had, it is one of the lower ones. We are lower than 2019 because I mentioned 2019 is because we also had a slowdown on the market in the market at the time. The property stayed on the market a little bit longer as well. So by looking at that differences between the active listings and the number of sold, we can see that this is actually not as much as the 2019 level yet. So the demand is not as high as before, but then the supply is definitely not as high as in 2019. And then the differences is actually smaller than 2019 if we compare to what we have right now compared to 2019. So what can affect the demand on the market? So we're going to look at one of the biggest factors right now is because of the interest rate. And as always, we track these Freddie Mac, Fannie Mae, Mortgage Bankers Association, National Association of Realtors, their projections, and they have been increasing their projections on their mortgage rates. So we definitely see that they are going up, but it seems like the 4Q, they're all topping at 4Q. And then for Freddie Mac, Fannie Mae, and Mortgage Bankers Association, expecting they're starting to stable and slowing down or maybe come down slightly by 2Q of 2023 and 3Q 2023. So that can absolutely affect your demand. But now, also, CNBC had a segment, and then they looked at the consumer housing intentions by UBS lab survey, and the 36% of people that they surveyed plan to purchase a residential property in the next 12 months. We mentioned again a lot before is that a lot of people are taking a pause to buy. They're not stopping buying properties. They're just plan to purchase it later in the next 12 months. They're observing right now. And then there are 27% plan to sell their home in the next 12 months. And 66% believe that finding an affordable home will be somewhat to very easy in the next 12 months. So definitely we're going to see some increase in the demand to purchase property again. And I think that the price will drop to a level where people are going to just come back out and say, you know what, even with a higher interest rate, I think it is time to come back out to look, because at the end of the day, we want to know whether the supply is really satisfying the demand that we have. Now, speaking of supply, of course, we really need to rely on the construction in order to satisfy the supply. And we've been talking so much about the shortage of housing in the country, and especially in California. And maybe Greg later can confirm or let me know whether my number is right or wrong, is that in California, we're short about 2 million units. Is that number about right?
I think it's a bit exaggerated, but there clearly is demand in California for housing.
So how many units do you think that is really short by?
I think it's over. I think we overestimate the number of units that are in demand based on not only population growth, but household formation. And, we're seeing an exodus of people right now. And I'll have a slide that shows that in the Bay Area. But as a state as a whole, more people are leaving than are coming. So the population is actually declining. And part of that is that housing is just so unaffordable. It takes a long time to get housing built. And certainly higher interest rates aren't helping that at all right now. So I think that number tends to be exaggerated. I also think that the aging of the population, there's quite a significant baby boom population in the state of California, and those folks are going to be making decisions. Not only will they just be dying because they're getting older, but they may be moving into other facilities, whether it's active adults or assisted living type memory care things, and there's going to be a transfer of those units to younger folks. So that may alleviate some of that demand for newer construction than we would project. I just think that the governor had come out I don't know 2 years ago. Haven't heard much about it lately, but he came out earlier and said that we need, I forget the exact number, X number of millions of houses built per year, and I think that number was exaggerated.
So exaggerated, we would say about half of it would be more likely the number.
I think so. Yeah, I mean, it's probably reasonable. Again, I don't recall the number off the top of my head, but we're just not seeing population growth as significant as it was 20 years ago, 30 years ago.
That's good to hear. At least we are, in a sense that we at least not as bad as we thought, but at the same time, I'm really curious to hear about hear about whether the construction is really continue to increase or not. And like this chart or this graph has shown by CNBC is saying that actually housing completion, we've done better than last year. We had increased 9.3% of the housing construction. So that's great news because we definitely need more supply. And then Jerry Howard is the CEO of National Association of Home Builders. He does feel that the market is definitely suffering. And he says U.S. home builder sentiment falls. So I think this is a good segue to come to you now and then ask you what you think, because obviously you give a lot of these home builders your advice and your data as well.
Yeah, let me pull up my slides
and just a reminder for everybody, if you have any questions, feel free to type it in a Q&A, and we will definitely try to answer you during this this time.
Hang on. We got it? Does that work?
Let's see. There you go.
Okay. All right, good. So thank you. And that was really thorough and very good. I enjoyed listening to that. That was wonderful. I'm at the Gregory Group. We do two things primarily. We have an information side of the company where we survey new home projects throughout Northern California. We do that on a quarterly basis. So our most recent quarter was the second quarter of this year. So ending in end of June. So we've missed a little bit of the July and August numbers, although I have some input on that. And then the other half of the business is where we do consulting. We work with home builders and banks and all of those folks in putting together feasibility and just general economic and demographic and so forth studies. So what we wanted to do is sort of give a top line view of what we're seeing in the Bay Area in terms of the new housing market. And I know that the Bay Area is typically considered to be the 9-county area. We survey 7 of those counties. We don't survey the city of San Francisco or Marin County, but everything else we do. And so it's sort of all of those together. So it includes Napa and Contra Costa and so forth. So you're going to see numbers that reflect all of that information. So anyway, the first thing that I think, Helen talked about this a little bit, but we have a graph here of Freddie Mac's 30-year mortgage rates going back to when they first started back in the 70s, so 50 years. And we were all been pretty. We benefited a lot from, in the 80s when interest rates declined, and they've been historically low for some period of time until very recently. And in fact, in December of 2020, the end of the first year of calendar year of the pandemic, we saw interest rates down to 2.68%. which if you had $1 million home with 20% down, 30-year mortgage, 1.06% tax rate, your payment would be about $4,100. Pretty good rate for $1 million home, $800,000 mortgage. However, over the next year and a half, the interest rates have actually increased. And this is the way that we take this number is it's an average of the month. And so in July, that average was 5.41%, almost 5.5%. You do the same calculation, you get a mortgage rate that's about 5,300. That's 31% increase. The thing to notice about that, or sort of be aware of, is that it's $1,200 extra in payment, which is quite significant. Requires about a $40,000 to $50,000 more in income during that time. Now, incomes have been increasing as a result of inflation and a tight labor market, but not 31% over the last 18 and a half months. So the price of housing, the cost of housing related to mortgages and so forth has certainly increased. We would say as well that what we found is that there seems to be an inflection point around 6%, because there was a month where the interest rate did get to 6%. And when we saw that occur, we really saw an abrupt slowdown in activity. And that includes traffic and down payments and deposits and so forth on new home projects. So the good news is it seems to be moderating at this point, especially as inflation comes down. But it's still an unknown. I mean, if I could predict mortgage rates in the next 2 years, I'd certainly be in somewhere like Vegas instead of Sacramento. And it's just very difficult to do, to know what the Fed's going to do and so forth. But anyway, it has clearly increased the cost of housing. And, it's interesting too, because, and when you talk about a $3 million house, it may not affect it quite as much. There may be a greater impact from the stock market decline and people taking money out for that purpose. But when you get in the $1 million range, you start to have a more direct effect. People tend to be a little bit more price sensitive on the cost of housing. What is the cost of housing? Well, if you take all 7 of those market areas and you do an average, you see we're about 1.14 million for that, an average of all those homes. That's up about 10% year over year. So, second quarter through second quarter, you can see the changes there over time and so forth. That's the highest it's been in 20 years. But we think that's going to be the height of the market, and we think it's going to start to moderate off of that. It's price decreases in the second quarter was 20%. The year before it was 0. And no price changes is at 52%. That was very low last quarter or a year ago. And really the main thing we saw were price increases. And you can see that on the graph is the last year. And the number of incentives, the value of incentives, it's base price, and then the builders will offer incentives, has increased about 56%. That's a pretty moderate number at this point. I would suggest that in July and August, that number has increased. I'm not convinced that price decreases. Actual base prices have decreased significantly. But I think incentives have gone up, and a number that people can use towards options or upgrades or premiums and so forth. And sales have certainly slowed, and I'll show that in a second. But it's interesting to keep in mind that in the home building world, due to a number of factors, a great volume of sales, but also the supply chain issues was really a huge impact on the home building industry. I've driven by projects that was essentially complete except for a garage door, and you saw just plywood up, and the house not being finished, and builders trying to get people to close with no garage door and saying it'll come. And so those type of things really slow things down. Those are starting to be alleviated in some degree. And there's a significant backload that builders have throughout California and really throughout the nation. And so I think that we're going to see builders really concentrate on getting those homes closed through the rest of this year, and be a little less concerned on the sales side. And in view of that, I think that you're not going to see huge base price decreases, because one of the things that happens is then people that are in escrow come in and say, hey, look, you just decreased prices 50,000. I'd like to have $50,000 off my house. And so I think they're going to want to try to stay away from that. So I think the pricing, I do think it'll moderate and it'll start to come down in the third and fourth quarter, but I'm not sure it's going to be as significant as people think. I would also note that at the end of the year, I think the price appreciation will be positive. Depending on where you are and what market, we've seen prices go up significantly, 30, 40, even 50%. And if a price comes down 10% or even 15%, I think that most buyers are still pretty happy with that over a period of time. So sales have actually is the one that's hit the wall pretty significantly. Year to date, sales are down 44%, a pretty significant impact. We think at the end of the year, they'll be down 30 to 40% in the Bay Area, potentially more depending on how it goes. But you can see the drop off. It sort of started about a year ago. And if you look at the trend, the 4-quarter trend, part of that is due to pricing and increasing interest rates over a period of time. But really a lot of it's due to increasing inventory as well. And this slide here shows the increase in, decrease in inventory over that period of time. I misspoke. So you can see that, at the beginning of the pandemic, inventory really decreased significantly, going down to near all-time lows in the second quarter of 2021. And a pretty steep decline as builders slowed down the release, and it became harder due to supply chains and all those things to finish homes. So they were holding off projects or holding off homes entering the market longer as prices increased and so forth and so on. But we do see even in the second quarter, we do see an almost 100% increase in inventory. And we do think that's going to continue at a pretty substantial rate over time as we move forward. And so we'll see those as the next quarters come out. And so, a lot of what we look at is certainly pricing and sales and inventory, but we also want to consider what drives the market. And it's really, really fascinating in California as a whole, in the Bay Area, certainly, as a segment or a region of that. And so one of the things that we looked at is, and I sort of alluded to this earlier, is this whole aging of the population. And the California Department of Finance makes projections. And I would just say that I think these numbers will probably change a little bit. Pandemic has thrown a wrench into some of how it's calculated and what's happened and so forth. But I think that it's in the July 22 numbers aren't out yet. So I think that while they may change somewhat, I think the overall trend of what's happening is real. I think we can all see that as we move around town and so forth. But really, the fascinating thing is that over 65. So what we've done is taking age cohorts by population by age for all 9 counties, and then we said, well, how does that? And then taking the projections of the Department of Finance and what is that difference? And when we look at that, we see, for example, that under 24 is actually declining. It doesn't mean there's no one under 24 years of age. It just means the number of those folks is going to be declining over time, the next 10 years. And clearly we know the population's aging. We see the 25 to 34 where the millennial generation and the Gen Z population is increasing. But 65 and over really makes up only 23% of the total population, but it makes up 99% of the population growth. That the baby boom population is huge, and it's clearly aging. So how does all of this fit into what we think is going to happen in housing? Well, clearly, we see a opportunity for older for housing that addresses folks in the baby boom generation. And that's a whole variety of things, really. That's active adult, age-restricted housing, things like Sun City, Sarah Shea's doing some trilogies, those type of things. It also includes things like assisted living, memory care, independent living. Certainly, as the age over 75 population increases, that becomes a bigger factor. A lot of people, keep in mind, want to age in place. And even though their homes may be 30, 40, 50 years old, there's this segment of rehabbing homes, that's going to be pretty popular going forward for some of these folks as well. And then, lastly, a lot of these folks are leaving. They're moving to either where their kids are, and that could be, Brentwood, it could be Sacramento, or in a lot of cases these days, it's out of state completely in the communities like Arizona and Nevada or Texas or Florida and so on, for a variety of reasons. Following kids tends to be a big one, and the kids can't afford California in large measure. So we just see this huge older population. And then on the other side, especially in the Bay Area, it's going to be really focused on affordable housing, more attainable housing, a lot of high density attached, high density detached, in that $1 to $2 million range, let's just say. People have a good job at Apple or Facebook or whatever, and can afford that type of house. Where it gets more dicey is in the middle ranges with growing families. That product becomes very expensive. A lot of those folks are moving to outlying areas. We see a big influx in areas like Lathrop and Tracy and Stockton and Manteca, and certainly Sacramento region overall. So this is really something to watch as we move forward. I mean, it's really becoming a significant factor. And then, also this whole part of people leaving the state. And so what we looked at was from in July of 20 and in July of 21, and made the comparisons to, again, the 22 numbers aren't out yet. And, it just turns out that people actually are leaving the state. And leaving the Bay Area in particular. So if you look at, there's two segments to it: natural increase, which is births over deaths, and that's still positive, although it's declining. And I wouldn't be surprised as we move into the future, as that last slide illustrated, that more people the number of deaths will exceed the number of births at some point in the future. But really, the migration trends are the ones that are most impactful. And if you break that out into a net foreign immigration, we see that that's still a positive number. So there's more people from other countries coming to California and the Bay Area. But the net domestic migration is very negative, and that translates to a big number of overall net change of people leaving. So more people are domestically, there's still people coming to the state, believe it or not, but there's more people that are leaving to other states. And again, that's, tends to be areas like Arizona and Texas, and, it was Boise and Salt Lake City and Nashville, and those areas have slowed as pricing is moderated there. And Florida, certainly. And so overall, what we're seeing is that there are more people, net change, the bottom left slide, that people are leaving the Bay Area in greater numbers. So the population is declining. It's also hollowing out. It tends to be more middle income folks, middle-aged folks that are leaving than certainly a lot of older folks are as well, and younger folks do as well too. But as you saw earlier, there's a greater increase in those populations than there is a decrease. And so I think that's worrisome, in terms of affordability, the very rich people, and then the folks that are at the median or a little bit above in the income that can't support California and the way of life that we've all become accustomed to. So part of that is there more opportunities for affordable and obtainable housing. We're seeing a little bit more of that in Central Valley communities, and I think we'll still see more of that as time goes on. But that's a big factor. It's clearly the migration trends are a big factor in housing, and the Bay Area is affected by it. So just, in the future, what are we seeing? Well, builder confidence, yeah, it's declining. Helen alluded to this, but it's not dead. I think that builders are sort of taking a wait and see approach at this point. Let's get through our backlog and our closings. Let's see where the economy is in January, and then we'll make some decisions about whether we need to have layoffs or how we want to proceed at that point, or delay projects, whatever it is. Land deals, we're still seeing land deals occur. We're seeing them being considered, certainly much more cautiously. The amount of time, their feasibility periods, the negotiations on land values and terms are certainly up for grabs, but builders aren't laying off their land divisions, and they have they have enough land for next year generally, but they want to be prepared for years after that as well. So they're moving forward. Material and labor cost, we're seeing some material costs, lumber's come down off the highs, but we're really not seeing any relief in cost to build a house at this point, which is interesting. I think partly because there's this backload and builders want to make sure they get through that. And in order to do that, they need all their subs working at full speed. I don't think we're going to know anything on that until next year, how that relates to the economy and so forth. And then demographics, we call it first time, last time, or first time buyers and last time buyers. I think that's going to be a huge opportunity throughout all areas in California, frankly. We're seeing a lot of active adult projects in Sacramento and then certainly Central Valley and North Central Valley as well. Didn't talk about work from home or work from anywhere, and who really knows at this point. It seems to fluctuate. Companies want their workers back. Workers don't want to go back. There seems to be a war. It's becoming a little bit more hostile. There's this new trend called, what's it called? Oh, I forget the name, where people are just not working as hard. There's a term for it. It slips my mind. They're still working, but not as hard. And so there's this whole where we work, when we work, all of the stuff is up for grabs, I think. And I don't think we're close, frankly, to settling that. But we are seeing supply and demand rebalancing. I'm not a big guy that says, well, inventory, because we don't have any inventory, there's going to be, we're not going to have any sort of crash or anything. If pricing of homes is too expensive, it doesn't matter how much inventory there is, little or a lot, people aren't going to buy houses. It just doesn't matter. And so if interest rates are ticking up, if pricing doesn't moderate, it's not going to matter, frankly, if there's no inventory or if there's a lot of inventory. So I think it's more involved than just an inventory question. But we do see supply and demand starting to balance, and I think that's a positive thing. So with that, I'll certainly answer any questions, but that's it. Let me get out of this.
That's awesome. Greg, I think I have a lot of questions already regarding the net migration that you had mentioned just now. Do you think that because, during the last 2-3 years, because of COVID, a lot of countries were shut down, and that had affected the migration from foreign countries?
Well, yeah, absolutely. I think it's that, but I also think it was political. There were some policies in place that discouraged immigration from overseas, whether it was workers in Silicon Valley. I think those have been ratcheted back. Certainly on our borders, we haven't had as much crossing in terms of helping out in construction and in some of those areas that it's always been very positive influences. So I don't know. I don't have an answer of whether that will increase in the future or not. I would think so. I mean, it would make sense to. We have to in one sense, because there just isn't enough internal population growth in the area. And so the only way to really get there is through growth from outside.
Because one of the main reasons I asked this question is because in the past, we had so many clients. I'm talking more than half of our clientele will require some sort of work visa to work here.
Right.
But we really have seen a drastic drop recently in the last 2-3 years. So that make me really feel like, well, we have this huge drop of foreign immigration in the last 2-3 years. And I'm hoping, just like what you're saying, and I think we need it, is that in the next few years we're going to start increasing them back. And I just came back from Asia for family vacation. Hong Kong being such a free city financially, but then of course they're under the China's right now. they were still under this 7 days quarantine period until just 2 weeks ago. 2 weeks ago, they just dropped it down to 3 days. So they are still requiring people who going in and out of Hong Kong to have the quarantine period, not to mention in China,
Right.
every city you go to, you still have to be quarantined.
Right.
So it is definitely, that's one of the example how that has affected a lot of people coming to the United States, because obviously the Chinese investors were one of the largest percentage of the foreign investors.
Yeah, I think it's interesting too, though, and I don't know how this plays into it, but the whole work from home or work from anywhere thing, I mean, maybe that means that not as many people from out of the country will move to the States because they don't have to, or maybe they'll move somewhere else and that's maybe more accommodating than California, or if possible, I don't know. And so I think there's opportunities, and I just don't think we know that yet. I just think it's played out, but I think the fundamental point is absolutely right, and that the only way the population is going to grow in California is through some sort of probably foreign immigration. It doesn't seem like domestically people are wanting to move from Texas to California. Now some do, for various reasons, but overall it's just too pricey, and it doesn't, housing is certainly pricey, but gas is still $5.50, and everything else, utilities and all that sort of stuff is expensive. Food's expensive.
Yeah.
So it's not cheap to live in the state anyway. And if other states have opportunities that are similar, maybe weather's not as good and some of that sort of stuff, but I think it's going to be a challenge, and I'm just hopeful that politically we don't get too far behind the curve in California, that it becomes a point of no return.
I absolutely agree with you. And, one of the common feedback from other countries, especially in Asia, since that's where I'm from, and I still have a lot of families back in Hong Kong, is that to them, over here in Silicon Valley or in California, is very affordable. You actually own a piece of land here. Over there, you only own a tiny little piece of apartment unit, right? So that's why within United States domestically, we are one of the most expensive. But then if you look outside the country, going back to Asia, they look into here, they feel like, wow, I get the land, I get the weather, I get these, employment. It's very attractive. And I do know that a lot of parents over there would much rather send their kids over here for school and hoping that they would get a job with one of the biggest technology companies over here.
Right.
So that would be really interesting to see how that the foreign immigration, whether it will increase or not in the next few years. And when you said that builder confidence, they're declining, not dead. So I believe that you work with a lot of new home builders, and we actually have noticed during the market when it was really, really hot, home builders, they were really tough on the consumers, really tough on the buyers. Literally, it felt like we are doing this auction, almost like you're going to a market and hopefully you can grab one of these units, doesn't matter the location. But now they're working really hard trying to find buyers and then giving away all kinds of incentives. Are you seeing that as well?
Oh yeah, funny how that works, isn't it?
Yes, it just completely turned over. I mean, I felt so bad for our buyers before. We had to go to the builder office every single day, and there were hundreds of people there.
And then you mention it to the builders and they go, what are you talking about? The memories are short. But, I mean, yes, absolutely. I think that, again, our information is the 1st of July. And so in July and August, what we've been seeing in our consulting work, and certainly with our conversations with builders, is that it's the incentives are ratcheting up pretty significantly. And they're being used for a variety of things. Their buy downs are big. To get the interest rates down for 3 to 5 years or whatever it is. And then also for options and upgrades, because not all of that is a direct cost. It's sometimes, if you put $50,000 for upgrades, it may only cost the builder $30,000 or $25,000. So there's some advantages there. And then, there are some that you can use it towards, certainly closing costs, but then towards the price of the house. but we're not seeing a ton of that, as I mentioned earlier, because I really think that they're afraid of having to go back and renegotiate actual contracts with the clients today. And most of those clients, as you had mentioned earlier, the cancellation rates are certainly increasing, but they're not soaring necessarily. They're not going through the roof. Some of the people that are locked in are wanting to close on their homes. And so I think that will continue. And I think that will continue. I just think there's going to be a big push to finish those homes by the end of the year. And I don't think there's going to be as much emphasis on selling existing stuff. We'll see. I don't think they're going to abandon it, certainly, but I just think that it's a little bit more concentrated on their energies.
It seems like it will be a tough position as a home builders right now, considering the market is coming down, the demand is lower because of the interest rate, and at the same time, their construction cost has gone up quite a bit.
Yeah, they're in a squeeze, because they're already locked in on their land, and they're pretty much locked in on their construction costs if they're building now, and sometimes materials, if they haven't locked those in, are increasing as well. Although we do see supply chain constraints easing, which is a big factor in all of this. But yeah, so they're, but remember too, when the builders bought the land and when they put their pro formas in place, if they're selling now and they're closing now, it may have been 2 years ago or even 3 years ago when they did that. And so pricing may have gone up, like I mentioned, 30, 40, 50%. And so if they have to go back 10% or 20%, I don't, as long as they don't lose all their current buyers and so forth, I don't really think that that's going to be a huge hit, overall. It certainly will impact them because the price, like you said, costs have gone up. And they certainly don't want to do it from a business standpoint. But, in a market of what we're dealing with, I think that's, not the worst case scenario in the world. And by the way, we're not seeing the significant increases in foreclosures or short sales at this point. Everybody has a job, as you'd mentioned, and so there's no sense of this is anything like 2008 from anybody in the fundamentals. And there's nothing that we're not seeing. Last time no one could see what we weren't seeing. We didn't even know what we weren't seeing. There doesn't seem to be that this time. Now, who knows? But ultimately, that doesn't seem to be the case here. It just seems to be. Look, I think that the Fed is trying to tackle inflation. They're being aggressive on interest rates. The rest of the economy is actually doing, I think, very well. Good, okay, however you want to classify it. But the brunt of interest rate increases tends to be those industries that are interest rate sensitive. And what's the number one? Well, housing. So
exactly.
So I could see the Fed sitting behind closed doors saying, okay, well, look, we'll raise interest rates and we'll get inflation down and under control. They may hit a little bit of the stock market, but that's gone up for 10 years straight. And home pricing's gone up 50%. And so, if it comes down 15%, okay, but we're not gonna, politically, that's not a bad thing for us. People still have jobs. Yeah, maybe it'll tick up a little bit, but so right now it seems to be going according to plan. We'll see if it continues that way, but
Well, so let me ask you this then.
Yeah.
This is a tough question. How much longer do you think this slump is going to last? And do you think the housing prices is going to keep dropping for the next 12 months, or you think it's going to be something by next year, early next year, it's going to bounce back up?
Yeah, I think pricing was certainly going to continue to moderate this year. I don't think there's any question about that. And then I think it will depend. There's about a 50-50 chance, I think, and I think a lot of people would say this, of a recession, a true recession in first or second quarter of next year, depending on the results of the Fed, how the Fed maneuvers this and so forth and so on. I don't think we're in a recession by any stretch of the imagination today. Now, maybe people could say we're in a housing recession because it's fallen pretty significantly in a lot of sectors, a lot of areas. But I don't think we are in the overall economy. We may hit it, next year, and if we do, then I think, I think that we'll continue to see moderating pricing and sales for next year. We're actually projecting a price decrease next year in a lot of markets, not significantly, but a little bit. It won't happen this year just because of the way the numbers are stacking up. And so that we think that's potential. But look, consumers now, the buyers and the agents and so forth that we talk to are saying, look, the buyers are, they're not necessarily eager to go out and buy a house if, they think the price is going to go down $20,000 and, in 6 months, or, they don't have to move. And those that do are,
Right.
they're doing what they have to do. But, if you're buying a house and, maybe, 70% of home owners in the state of California have a mortgage rate that's under 4%. 90% have one that's under 5%. I think that's roughly the numbers. If you don't have to move, like you've been transferred or, your house is falling apart or whatever, why would you go anywhere if you have a 3.5% mortgage rate and you'd have to pay, 5.5% today and spend more money for the house? So those are questions that buyers are asking themselves, and they're saying, well, maybe we'll let this play out a little bit longer. And I think that's happening.
Yeah, I think I keep going back to how this internet has like two sides of the debate right now. One side's like, oh, the housing market is going to crash big time. It's going to be really bad. And the other side's like, no, it's more kind of like, yeah, our economy is doing pretty well. We're not going to see this big housing crash. And if any of the realtors say, hey, look, this is nothing, it's going to be okay, then they can say, of course, you guys are salespeople, you're going to say that it's fine. So that's why I've been trying to avoid that. What I think that the house market is going to do. However, one side of the story is that, okay, the housing market is going to crash because we might have a surge of inventory. A lot of these sellers are going to want to come back out and want to sell their properties, and that's when the market's going to crash. But at the same time, we saw that back in 2008, when the inventory was really high, was because so many homes were underwater and they went into foreclosure or short sales. And that numbers, if we look at the foreclosures, even though we have the moratorium lifted now, so the banks can actually start foreclosing, that number is nowhere close to what we had back in 2007, 2008.
Right. I just think that, if everyone starts putting their house on the market because they want to sell, maybe they're trying to grab the last remnants of this, of this boom here in the pandemic. But, ultimately, they're going to have to make a decision then whether they keep their home on the market or not. And, I think a lot of those folks will probably just take it off the market and say, I don't want to take $50,000 less, I don't have to move, and I can suffer, I can deal with this for another year or two or whatever. And so I think that's happening. Home building side, it's a little bit different. They have a project, they open it, and they, give units available for consumers to buy. But, it takes so long for projects to get approved in the state of California that it makes it difficult to see any real surplus of inventory, certainly over the last 10 years. And we haven't seen that. And so I'm not too worried about that on the new home side. And I'm really not that concerned about it on the other side as well. I just don't think inventory is it's certainly a metric, but I just think the cost of housing and incomes and interest rates and affordability is a gauge to really pay attention to. And employment, ultimately it's going to come down to employment. So
that's a really great point, because the market has slowed down quite a bit. Some of the sellers, like I mentioned earlier, if they are on the market during the summer, that's because they really are very motivated to sell. But then there are also a lot of sellers, they pull it off market because the rental market is still really strong.
Right.
They can easily just rent it out and then still either break even or cash flow.
Exactly.
So that's actually happens to quite a few of our sellers right now, saying like, hey, we're going to pull back, we're going to rent it out. And they actually rent it out really quickly.
Right.
And then they're going to come back next year when the market's better.
Yeah, I agree. I think we're seeing that all over California, actually.
Yeah. And then this is really, I think it's a really interesting topic, and I always think that we have clients, buyers who are really concerned about the market. We do feel that, I mean, again, I always think that maybe I am biased. I'm a realtor, but you know what? I'm also an investor. As an investor, I would love to be able to buy all these great deals. I would love the market really come down more, have a crash, so we can go out and invest more. But it's just that when we look at all these different factors, it just doesn't seem like our employment is great. Our, the only thing that I see is that the interest rate has affected so much of people's affordability. And then the stock market, some of the buyers, they are really waiting for the stock market to come back up, and so that they can pay for the down payment. But otherwise, consumer confidence level is not too bad. So yeah, I don't see that the housing market is going to crash like some of the people have said. Maybe I'm just looking at Bay Area. I don't know about any other part of the country. Do you think?
Well, yeah, I mean, look, I was on a plane, I don't know, this was a couple of years ago now, and I heard some guy behind me telling some guy, they were talking about the housing market, and I perked up, so I listened to what they were saying, and one guy goes, yeah, I'm gonna wait, because I think we're heading for a crash, and it's going to be like, maybe not as bad as 2008, but it's going to, we're going to crash, and so I'm not going to buy now. And of course, if he bought, he would have had a 50% increase in value of his home. So no one, this whole internet debate to me is just silly. I don't really pay a lot of attention to it at all. If you look at some of the data points and so forth, we're not like, I think I would agree with what you just said, but what does that mean for next year? I don't know. I don't think anybody knows. And you got people that'll tell you what they think is going to happen, even economists. And the economists are wrong. I mean, most of the Fed didn't think there's going to be inflation.
Exactly.
So they're supposed to be the smartest guys in the room, and apparently they're not. So I just think the way I look at it is that you should be prepared. Like if you're an agent, or if you're a buyer or a seller, look, if the market recovers and come January, everything goes back to normal, then great. And you're in a good position, know what to do. If the recession comes in January and it hits, for 2 or 3 quarters, well, okay, then have a plan for that, and be prepared and plan out a strategy. I think that's the best way to move forward at this point, because it's just really, really unknown. It's just, people are just up. Everybody has an opinion on where interest rates are going, and there's seems to be no middle ground anywhere. And it's, even when you take the averages, the numbers are so disparate that it's just really hard to figure it out. So.
Yeah, and that's funny. You just said that even economists are wrong sometimes, and which is really true. And then even we do those projections, mortgage rate projections by Mortgage Bankers Association, NAR, and Freddie Mac, Fannie Mae, and their projections change on a monthly basis or quarterly basis. So these are created by the smartest people trying to project the mortgage rate as closely as possible, but it fluctuated over 100 basis points from, just a few months ago. So at the end of the day, I think people, when you listen to the internet, on the YouTube channel, including ours, look at the data mostly, and don't be so affected. We have buyers that emotionally really affected by these news, and your neighbors, your friends are all telling you like, this is such a bad time, don't buy right now. The time is yours. If this is the right time for you, and it is. I agree with like maybe investors, home flippers, and builder could be a little concerning, because they have to figure out the cost, and then so that they don't lose money. But if this is for you yourself to live in, you're planning for long term. This is not a short term investment. Right.
People ask me quite occasionally, should I buy a house now or not? Just friends or whatever. And I always say, well, what's your goal? What's your objective? Are you going to live in it for 20 years, or are you going to live in it for 2 years? And you can provide an answer based on that. If it's 20 years, yeah, go buy it. I mean,
Exactly.
you can refinance when interest rates go down again, and you can afford it and everything. But if it's 2 years, well, you probably want to be a little bit more cautious. Maybe it's time. If you have to go, maybe it's not. I don't know. But you can pan it out or pencil it out, or whatever scenario works for you.
Absolutely. Absolutely. I really appreciate you, Greg, for
Sure.
sharing so much information
Sure.
with us, and then letting us know what your thoughts about this market. But I hope that our audience got a lot of great information, and then use the most important thing is that we are sharing statistics with you just so that you can make the right decision for your own investments, or if you're an agent, use those information to advise your clients. So, well, hopefully I can see you guys next month. And thank you again. This will be edited and posted on our YouTube channel. So give us about a week or so and you will see it on there. And don't forget to subscribe. Thank you so much again. Thank you, Greg.
Thanks. Yeah. Good to see you.
Good seeing you too. Bye.